Hey everyone, this is Professor Wei here. In this video, I want to cover the topic of financial statement analysis for this course. This is I would say it's a generic or general discussion on four things. The first one is the structure of statements. The second one is the some primary accounting variables. Third, I want to talk about the idea of common financial statements, and then I will move on to a brief discussion of accounting ratios. Okay, so these are very important tools when it comes to the fundamental analysis of in finance in general. And actually, there's a standalone discipline for financial statement analysis. It's a very huge domain. Okay, so of course we are not able to cover everything. I think this just lay out the framework for you to move forward. Even if you read every single paragraphs on the chapter, it's not even enough. Uh, there are lots of accounting details behind, but we don't need those exact accounting details as long as we are able to understand the notion behind those accounting numbers, ratios, and statements, and be able to use them for financial analysis. You should be fine. This is a really long journey in your finance profession. Okay, so let's get started. First, again, let me share my lecture notes. Okay, so first, the basic framework for financial analysis. I would say accounting is nothing more than the language of finance, and I said that on day one, because virtually all the finance uh, notion are indirectly or directly derived from the subject of accounting. Okay, but before we move on, I want to introduce you the notion of the distinction between the stock variables versus flow variables in accounting. All right. Uh, let's take a look at example. If you think about the notion, the concept of a balance sheet and income statement, it's exactly the comparison between the stock versus flow. By stock, I mean the current financial statement, the financial status of the company. Whereas flow measures the rate of change of the financial status. If you look at the income statement, when we talk about the revenue, we are looking at the financial status over a certain time span, over a certain fiscal year or quarter, right? Whereas the balance sheet captures the financial status at that single time point. Okay, it's a snapshot. So every single accounting variables listed on the balance sheet that captures the current status, whereas all the variables on the income statement that captures the flow of the financial status. Okay? A good visualization is that you can think of the context of a hot tub or bathtub. All right. When you turn on the water faucet, the water flow into the tub is similar with the notion of income statement. The level of the water in the tub is captured by the balance sheet. Okay. Well, that doesn't help us a lot, but it at least give us, help us to visualize the distinction between the notion of two important accounting statement, and balance sheet and income statement. All right. Now within the balance sheet, we are essentially following this identity. And that is total asset is equivalent to the summation of the total liability and the shareholder equity. Okay. On the left-hand side, you have the asset. Basically, it's nothing more than the summation of short-term current assets and the long-term fixed asset. When we talk about the short-term, we usually refer to assets within a year of lifespan. And we have long-term. It could be tangible and intangible. PP&E, patent, and many others, R&D, right? So there are lots of intangible assets as well, depending upon the nature of the company. On the liability side, we also have long-term and short-term. The difference between the asset and the liability that captures is the equity value, all right? Or we call it a net worth. Another very important variable in the balance sheet is what we call the net working capital, and that measures the difference between current assets and the current liability. So in a healthy financial condition, this number has to be positive, right? Why? Because if your current short-term liability cannot be covered by short-term assets, you're going to be into trouble, right? You will be trapped into short-term solvency issue. You cannot meet your short-term obligations. So this is very important in terms of short-term financial, stress. And also you have the liquidity. This one is different from the liquidity in the stock market. This one measures, this liquidity refers to how easy it is to convert an asset into cash. Okay. Some assets are not liquid, like machine, building, whereas some assets are very liquid. For example, cash or cash equivalent, marketable securities. And these are highly liquid assets. It's also very important to look at the liquidity of the company. Of course, there's a trade-off. For example, if the firm hold too much cash, it means that it may undermine the potential growth because it's too conservative, right? If it's the cash holding is very less and may introduce certain, volatility. Yeah, I don't know. I mean, it's just a trade-off, but at least you want to know that liquidity is a very important measure because it captures the financial flexibility of the company. On this slide, I capture, a very generic balance sheet of a company. You can see on the left-hand side, it captures the asset of the company. You have current assets, fixed asset. On the right-hand side, you have the liability and the shareholder equity. Well, that's it. Of course, in the real world, when you look at the actual financial statements, which can be found on something called EDGAR, EDGAR, that's the platform where Security Exchange Commission require all the public traded firm to post to file the accounting statements. In the comprehensive consolidated balance sheets, you can find out lots of details. But this is just a generic one. It tells you the structure of the balance sheet. Okay, you have cash, account receivable, inventory, net PPE, account payable, note payable, long-term debt, and of course, stock retained earnings. That's it. And of course, balance sheets need to be balanced. Okay. You can check out the link I posted over here. You will find out some, very I mean, all the financial statements you're interested of the companies. Now, another thing I want to briefly mention is the distinction between market value and book value. So you want to realize the fact that for accounting statement, it respects the historical value. Okay, it looks towards the past, right? But there is a distinction between the two. The market value is changing, and it could be the difference could be huge. If you look at the land of, let's say, the value of land over past a century or half century or past decades, it changed quite a bit. The current value will be much higher than the book value of the land, right? So when it comes to the evaluation, we need to be careful which value we want to use, book value or historical value. In asset pricing, there is a very important accounting variable that is the book to market or market to book. It means that to what extent the book value understate the current market value, and that measures the growth potential of the company. All right. So you want to realize that accounting statements, we use historical cost, but it doesn't give us the big picture. Okay. Now turning to the income statement, as I mentioned, it captures the flow of the financial status. It's a financial accounting statement structure that applies to a certain period of time, right? A quarter or a year. Now, this is a typical structure of the income statement. You start from the top line, that is the revenue or sales. And then you have cost of goods sold, depreciation, and then you have EBIT, earnings before income, interest and taxes. Now you minus the interest paid and taxes, that gives you the net income. Out of the net income, then you decide how much dividend you pay to the investors, and the leftover will be addition to the retained earnings. That's the structure of an income statement. Okay, so it's very straightforward. I have some number crunching examples on the slides. Feel free to take a look. Okay, yeah, that's it. So on my lecture notes, I also have some other topics, but this is the topic I used for my corporate finance, the taxes, and the cash flow statements. These are not required in this course. Now, what I want to do is to turn to the notion of common size financial statement. It's just unrealistic to compare financial numbers, financial ratios, or accounting variables across different companies, right? So let's say if you want to look at a large cap company's total asset versus a small cap company's total asset or liability, it doesn't make any sense because the magnitudes are different, right? You just cannot compare them on a dollar-to-dollar basis, right? So, for example, Google, it is one of the largest company in the world. Well, the R&D or the intangible asset, definitely, it's much larger than many other mid-sized or small-sized companies. You just cannot compare them on a dollar-to-dollar basis, right? to do that, we come up a way to normalize or standardize the financial statements. Okay, we have a beautiful name for this set of financial statement. We call it common size accounting statement, which allows you to compare the financial statements across different companies. To do that, we have to normalize, and that is compute the entire accounts as a percentage of something. In the context of common size balance sheet, we need to scale each one of the accounting variable by total asset. In other words, we are looking at the percentage or ratio of each one of the accounting variable on the basis of total assets. To what percentage, to what extent of the variable is with respect to the magnitude of the size of the company. Okay. Common size income statement is nothing more than you are using the top line sales to scale each one of the variable. Now, this is a brief example. You can see on the balance sheet, if you use the total asset to scale each one of them, you can see the cash takes 3.2% of the total asset. Account receivable, it takes 15% of the total asset. Inventory, 20%. Fixed asset, PPE, 60%. So you can see it gives you a direct sense of what's going to be the proportion of the PPE on the asset side. Beautiful thing. You can compare that 60% of Google to the percentage of another company. Right? Right? So similarly, you apply that structure to the liability. You basically use the asset to scale each one of the right-hand side variables as well. Right? So you end up with a set of percentages. Now, likewise, you apply the framework to the income statement. What do we have? We have the proportion of each one of the accounting variable. For example, in this case, the cost of goods sold takes 60%. You end up with a net income of 16%. Dividend of 4%. Now, when you add them up, that should give you 100% of the total revenue, right? Beautiful thing. Very simple. You can use that common size financial statements and apply them to make comparison decisions across different companies. Okay. Now, financial ratios. There are multiple categories of financial ratios, but this one I think is relatively, reasonable, more reasonable because I sort everything into 5 categories: short-term solvency or liquidity ratios, long-term financial leverage ratios, turnover ratios, profitability ratios, and the one that measures the market value. Okay, so you will learn more in your corporate finance class, but it's very simple. Let me give you the idea. What do I mean by ratio? It's nothing more than a ratio of two things. Okay? You can make comparison of whatever variables you are interested. Take the ratio, but you need to be able to interpret the rationale behind the number. For example, let's say the current ratio, and that is the ratio of current assets and current liability. So if you end up with a 113 of a current ratio, it means that you merely cover your current liability by current assets. That's fine. Okay. Well, actually, that's not enough. I would say if the ratio maybe I don't know, it depends on the size, but it's not a bad idea to have higher current ratio. And also you have the quick ratio because some of the assets are not very, I don't know, liquid. You need to take out the inventory, right? Because it's like less liquid. In this case, it's not even close to one or merely close to one, right? You also have the cash ratio, using the cash to see to what a percentage of the current liability can be covered by liability, right? So in this case, I would say it's not very sufficient. I don't know. It depends upon the size and the context, but this number give you the sense about the liquidity. Okay. There are some certain other ratios. I don't require you to do that, but they're measuring different assets. For example, net working capital. It's a major measure that is sourced from the daily operations and also some sort of an interval measure to see how long it takes to get the operating cost covered by the current asset. Okay, a similar idea. Okay, it's just a ratio that gives you a notion where the location, where the liquidity of the company is. Okay. You also have some other form of financial ratios like long-term measure, the leverage. Okay. That's nothing more than the debt over the equity or debt over the assets. They are the same. Okay. So basically, you use the total assets to scale the total liability. In this case, the leverage is 50%. And of course, it depends upon different industries. Some firms have higher leverage, some are lower. That's driven by the nature of the industry, right? You also have some other form of a long-term debt ratio using the long-term debt over the long-term debt plus the total equity. That gives you the debt ratio specifically over the long term because you can see on the denominator you don't have the short-term debt. So the whole idea is that you can use a variety of combination to give you a big picture, right? A single number doesn't tell you the big story, but if you look at all of them, that gives you information from all sorts of aspects. Give you a big picture of the company. You also have some other forms of income statement ratios, times interest earned, cash coverage, inventory turnover. There are thousands of accounting signals or ratios. You can even make it up, but as long as you can justify the rationale behind, you should be fine. But the ones that I listed on my slides are the most common ones. Some of them are not even mentioned by your textbook because it's not the exact focus of the discussion. You really want to, get the idea of what we mean by ratio. Okay, it's a comparison. It's just a language that tells you the financial status. Okay, we have a receivable turnover. and other sort of turnover ratios, how many times you turn around, something like that. Another very important measure I want to mention is the profitability measure. You have return on assets, return on investment, return on equity, profit and margin. It tells you one thing, how profitable the company is. All right. So you can see a common thread is that on the numerator, they're all net income, right? But the denominators are different. You have the sales, you have total assets, you have total equity. So the reason why we want to emphasize on those differences is the fact that there are different, there are all sorts of, accounting adjustments that may bias the accounting numbers. Okay, so for example, the sales is the top line of the accounting statement. Income statement, right? Total asset is the bottom of the left-hand side of the balance sheet, and total equity is the portion of total asset without the liability. They're reflecting different things, right? So for the first one, profit margin, so out of the preliminary sales, how much net income you have, right? Now, return on asset is how much proportion you have out of the net income you have out of the total assets. And the last one is the comparison between the total assets and the one without liability. We also have some other form of ratios like market to book. It dictates the potential growth of the company because market value is changing over time, where book value is historical value, right? And there are many others like EBITDA, enterprise value scaled by total EBITDA. That's another form of a earnings ratio. Okay. In corporate finance, we talk about this DuPont identity. Basically, you can decompose the profitability measure ROE into three components. Okay, and you end up with sales canceled over here, total asset offset over here and here, and then still you have the net income over the total equity. So essentially, you decompose ROE into profit margin, total asset turnover, and something we call the equity multiplier, which is a measure of the financial leverage, right? So anyway, it's not. You are not you don't need to be responsible for this decomposition over here. I'm just trying to show you that financial ratios can tell a lot of story. You can see profitability can be well explained by these a combination of these three things to be essentially you can argue which is the driver of the profitability of the company, right? Yeah, that's all what we have for this topic. You're more than welcome to read the chapter. Okay, so in corporate finance class, you're going to take a deep dive on the accounting statement analysis. In this lecture, what we want to do is to give you the idea of the structure of the statements, some primary accounting variables, some key financial ratios, as well as the notion of a common size accounting statements. Okay, yeah, that's pretty much what we have in this video. I'll see you guys in class.